In this video, I'm going to break down why you don't have as much money today as you had a year ago and what that means for your household budget in 2022. If you're new to my channel, a very warm welcome. I'm Martin Bamford, and today we're talking about possibly one of the most important topics in the world of personal finance right now. That is, of course, price inflation. We see it happening right now all around us, but what do today's official figures actually mean? Is this inflationary surge still transitory, or should we buckle in for the long haul? And what can we and what can policymakers actually do about it? Price inflation in the UK continues to surge. The official measure is now at its highest in a decade. That's the Consumer Prices Index, or CPI measure of price inflation. It rose 5.1% in the 12 months till November, up from 4.2% just a month earlier. It's the highest CPI inflation rate since September 2011, so over a decade ago, and it's ahead of forecasts, with economists expecting it to come in this month at 4.7%. According to the Office for National Statistics, that's the ONS, higher costs for energy and transportation are behind these rising prices. Grant Fitzner, who's ONS chief economist, explained that higher prices for fuel, energy, clothing and second-hand cars, and we'll come on to those in a minute, they all drove price inflation higher, with raw materials prices also rising. He said a wide range of price rises contributed to another steep rise in inflation, which now stands at its highest rate for over a decade. 5.1% is a big number. There's a bigger number out today. That's the Retail Prices Index, or RPI measure of inflation. That came in at 7.1% for the 12 months till November, up from just 6% a month earlier. It's the highest RPI figure in more than 30 years. And here's the thing about these price inflation figures. You and I are probably not experiencing the same rates of price inflation. The official figures are an average measure. They're useful for keeping a watching brief on the cost of living, but they're pretty useless when it comes to the cost rises we each experience as individuals. The inflation you experience will depend on the nature of the goods and services you buy each year. That means we need to look at the underlying factors, those behind those inflation figures, and it's essential to do that if we're to understand what it actually means for our bank balances. Take the cost of petrol, for example. Within the latest inflation figures was a record high price for petrol. It reached an average of 145.8 pence a litre last month. But as of yesterday, and I've just checked the RAC pump price tracker for these figures, the average price of a litre of unleaded petrol was 146.09 pence. Diesel was 149.58 pence. Roll the clocks back a year, and the equivalent prices were 114.79 pence for unleaded and 118.09 pence for diesel. That means the cost per litre has gone up 27.3% and 26.7% respectively in a year. So if the cost of filling up your car forms a significant part of your household budget, you're going to be feeling the pinch. There is significant inflation too when it comes to the cost of food and drink. Food prices are up by an average of 2.4% this year, but again, that average is hiding a range of price rises. Beef and veal, for example, up 5.1%, lamb and goat up 6.9%, whole milk up 5.7%, butter prices are up 8.9%. It's not much better if you're a vegan, with fruit prices up by 4.5%. And I know my 10-year-old crisp addict of a son is going to be dismayed to hear that crisps are up by 7.3% in the course of a year. There is some good news as well on food prices. The price of flour, other cereals, that's fallen by 10.3% in a year, and pasta and couscous, a favourite down here in leafy Surrey, down by 5.2%. We've seen the cost of second-hand cars rise sharply in the last year. Those prices rose by an average of 3.1% in a month last month, more than 27% up in the past year. Measured versus April this year, when lockdown restrictions started to ease a little, the prices for second-hand cars are up by an average of 31.3%. And the reasons behind these significant rises are twofold. Firstly, people looking for alternatives to public transport. They want to avoid sitting in a germ-filled box with strangers. And also the global supply chain disruption we're still experiencing. That's reducing the availability of brand new cars, so people buying second-hand cars instead. The ONS has offered a handy explanation for higher second-hand car prices, saying these latest movements come amidst reports of increased demand as dealers opened following the most recent national lockdown, together with a global semiconductor shortage affecting the production of new cars and resulting in consumers turning to the used car market. Additionally, there are reportedly concerns in the trade about the supply of second-hand cars because of a variety of factors. These include fewer one-year-old cars coming to the market now because of a fall in new car registrations last year, and the extensions of lease contracts and fewer part exchanges caused again by delays in new new car supply. So accepting that our inflation experience will be different depending on what we buy, and I've personally got no plans to go out there and buy a second-hand car in the next year, then what could price inflation at these levels mean for us? Money Facts have come out today with some decent analysis on this, concluding that households will see their real wealth shrink by thousands of pounds next year, and that's because money kept in cash savings earning a minimal rate of interest will have its buying power eroded by rising prices. Easy access savings accounts right now offer an average interest rate of 0.19%. So based on a £50,000 deposit, that would earn just £95 over the next 12 months. But over the same time frame, that 12-month time frame, a 5.1% rate of inflation, that would reduce the sum's purchasing power from £50,000 down to £47,540. That's a drop of more than £2,500 after the interest is added. And that's assuming that inflation stays at 5.1% next year. It could well go a lot higher. Yes, you can shop around, you can find the most attractive rates of interest for your cash savings. You can even keep your fingers crossed for an interest rate hike from the Bank of England tomorrow, and a bit more on that shortly. But over time, money kept in cash is guaranteed to lose its real value because the interest it earns will not keep up with rising prices. One option is for savers to move from cash savings to investments, which at least have potential to deliver returns exceeding inflation. But I accept that is not the right move for everyone. When you move from cash to investments, you place your capital at risk, and not everyone has the appetite for risk that they need to do that, or indeed the financial capacity to take on those types of risk. But you should understand the implications of leaving money in a cash savings account, especially right now with CPI inflation exceeding 5%. You will lose money in real terms. Which all takes us, of course, to the Bank of England and their next rate setting meeting, which takes place tomorrow. Will they be the first major central bank in the world to blink, to hike interest rates in response to rising price inflation? Despite what the financial markets are saying, I'm not sure that they will. Keep in mind, though, that the Bank of England is targeting inflation as measured by CPI at 2%. CPI inflation is now 5.1%, and that's got to be uncomfortably high for them. So back in November, at the last Monetary Policy Committee meeting, they voted to keep interest rates on hold at 0.1%. They voted 7-2 in favour of that rate hold, despite at the time a widespread belief that they would hike rates to 0.25%. What we do now have, following today's new price inflation figures, is a greater belief from the financial markets that interest rates will go up tomorrow. Interest rate futures are showing a 66% chance that the bank rate will rise tomorrow from 0.1 to 0.25%. Now, before the inflation figures came out, the financial markets were pricing in about a 50-50 chance of that happening. But also keep in mind that last month, before the Monetary Policy Committee meeting last month, the markets were pricing in an almost 100% chance of a rate hike, and they got it wrong. So these market predictions, they can be wrong, they can be inaccurate, at least in the short term. The higher than expected price inflation figures we saw come out this morning, they are definitely going to put pressure on policymakers, but I still don't think that we're going to pull the trigger tomorrow, and there's two reasons for that belief. First, it won't make much of a difference to price inflation here in the UK, which, as I've already explained, is largely driven by global factors, so the supply chain crisis and wholesale energy prices. If the Bank of England makes the cost of borrowing more expensive here in the UK tomorrow, so what? It's not going to fix the global supply chain crisis, and it won't bring down global demand for gas. What an interest rate hike here does, and this is my second reason for thinking it won't happen tomorrow, it will cause some financial misery at an already uncertain time. Omicron. Later today at 5 p.m, assuming he's on time today, Prime Minister Boris Johnson's scheduled to give another press conference. That follows on from his Sunday evening surprise for the NHS that they're going to need to give everyone a booster jab by the end of this month. Now, we already heard yesterday from Scotland about tighter restrictions around social mixing. England usually follows suit, so I'm expecting to hear something similar from the Prime Minister at 5 p.m. today. The UK economy is already hurting due to Omicron, due to uncertainty around Omicron. Cases at the moment seem to be doubling every 2 days, and the virus is once again running rampant. All this makes it more likely, I think, that the Bank of England will adopt a wait-and-see approach again this month and then make a decision probably at their February meeting. Usually, inflation of this magnitude would precipitate a rate hike, but these are not normal times, and there's a good chance we might not return to normality for a long time, if ever. In the early days of the pandemic, we often spoke about the new normal. Now, I don't hear that phrase being used very often anymore, but perhaps it's a term that we should be using now and keeping in mind at all times. times. I'd love to hear your thoughts on this one as we hold our collective breath and see how the Bank of England will respond tomorrow to these rising price inflation figures that we saw come out today. Also, I'd love to know what steps that you're taking to address rising price inflation. So are you cutting your budget by 5 to 10% next year? Are you taking steps to earn more money? Or maybe you're moving from cash to investments or doing something else? Let me know in the comments. I'd love to hear from you. If you found this video helpful, please do press the like button. Make sure you subscribe as well. Don't miss out on any videos I publish in the future. Thank you for watching this video, and until next time, I'm Martin Bamford, and remember, when it comes to your money, the more you know, the faster it can grow.